So in the past, we've talked about three buckets of money. Um, the taxable, tax deferred, and tax free. And it's best to have all of them. But why is it so troublesome to have majority of my retirement money in a tax deferred accounts like your IRA, 401k?
Yeah, this question and this situation also comes out of our strategy sessions with our clients. And so one of the things you see oftentimes is that, people have bought a house, they've made some money on the house, right? But they don't want to sell it. So, the equity in the house is just there and for either for beneficiaries or they could use it at some point in time. And then they had a 401k at work, right? And they put the money in, they got a match, and they don't have much money except that. So if you take a look, they have a little bit of money in the bank and a ton of money in a big IRA and house equity. So it creates some problems in several different areas. Number one, when they get to be 72, they're going to be forced to take money out, and obviously it's a huge problem, very inefficient to have more taxable income on your tax return than you were using in any one year. So if you're spending 75,000 a year, and all of a sudden you're putting 100,000 on your tax return, or 150,000 or 300,000 or 500,000, because you're forced. So that's one of the things you have to be careful with a giant amount of money in tax deferred assets like a 401k or IRA. There is a forced distribution. It's called required minimum distribution, and it will drive you crazy if you have a lot of money there. So sometimes by mitigating some of that by spreading it out. I want to have some money in regular taxable accounts. So, for example, obviously you'd have checking and savings and cash and those types of things, but you can have your same type investments, Vanguard and State Street and iShares or whatever, in just a regular account. It could be a trust account or individual account or joint account or any of those types of things. And what that does is it gives you liquidity. Taxes are lower because you already paid taxes on some of the money when it went in, and they're also it's capital gains tax instead of ordinary income, which is generally lower. So that's very good, but it gives you liquidity. And that liquidity gives you all kinds of power in terms of what you can do going forward. So, for example, if somebody wants to do a Roth conversion of some of those retirement assets, now they have some taxable money to use to pay the taxes. And they can fill that third bucket. And the third bucket, I think, is maybe the most important, which is this tax-free bucket, right? So, in a perfect scenario, you've got some type of distribution across taxable, tax deferred, and tax free. And man, if I'm heading into retirement, I am really trying to make sure I've got a distribution across all three of those areas because it just gives you flexibility. The other thing that a lot of people probably don't think about, but they can change tax laws really at any moment, and it might impact one category more than another. And so by having all three categories filled, you diversify the risk for tax law change going forward. So, if you have everything in tax free and they all of a sudden change their mind and make it taxable, well, it's a good thing that you had some tax deferred. Good thing you had some taxable. If they change capital gains rates and make it ordinary income again, well, it's a good thing you had tax free, that type of thing. So as tax laws change, you can make a really strong argument for having a distribution across those three areas. I would say this is the biggest falling down that I see for people's retirements is not having an even distribution. Not, it doesn't have to be even, but not having a distribution across those three categories. And we do see a lot of people that have a big chunk of their money in that, tax deferred area. And that is something that would be great to, if you could go back in time and kind of rectify that. So it's something, even if you're retired, you can still work towards, you can still start building up those taxable assets, those types of things. So it's, it's an interesting area, that's for sure.
Yeah, and another situation like we come across is say I want to buy a car, but I'm retired. I want this nice car that I've always dreamed about. I have the money, but that money is in my retirement account. And
Yep.
say this car is like $120,000 car,
Right.
but it's my dream car and I want it. But then my income just jumps that $120,000 because
Right.
I have to take it from, and it's considered my income then.
Right. Yep. Yeah. So got $120,000 on your tax return, and so you're going to need to pull out even more to pay the taxes. And if you're retired, that might jump you up in brackets on Medicare. Maybe you're now paying more on Medicare. Could impact those other costs also, and all of a sudden that $120,000 car end up costing you $175,000 after tax versus having that $120,000 in a taxable account. Some of that money you pull out, you might already pay taxes on. The rest that is a gain, especially if it's over a 1 year gain, will be a lot lower. It could be a 15% tax on that instead of what would have been a much higher tax as far as that goes. Have less chance of hitting your Medicare cost if you are retired, for example, those types of things. Oftentimes, some people will look at borrowing the money just to mitigate that as far as that goes. But then you run into other problems with borrowing, and now you've got a payment. And if the markets all fall apart, you've got a payment, and so it's hard to collapse your expenditures when some of them are fixed through payments. So that's where, yeah, exactly, having some taxable assets to do that gives you that flexibility without getting killed on taxes. Yeah.